Good morning and welcome to Master Trader, where you can learn to use simple market and stock analysis to make money investing and trading. I'm Greg Capper. This morning we're going to take a look at the trends in the markets, and I'm going to explain to you simple trend analysis without any indicators, without any trend lines, without any moving average crossovers and the rest of the nonsense that's typically used. Okay, so let's get going here. I have four charts up here: the S&P 500, the NASDAQ 100, the Transportation Index, and the Russell 2000. I look at these four every single day. And during the trading day, I do keep an eye on the S&P 500 spiders and the Qs to see which way that they're trending as a guide for day trades. So, as these are trending up, everyone wants to know, when is the trend going to be over? When is the market going to come in? And stay tuned. I will be soon doing an overview of the possibility of a stock market crash in 2018. So subscribe to the channel, hit the bell, and you'll get an alert when that comes out. I'm sure you'll find it quite enlightening. So, as the markets are moving up here, what we do here at Master Trader in a very systematic way is just follow the trend bar by bar, and then what I call pivot by pivot, or what you might know as swing highs and swing lows. And what we need to do is define exactly what those are. Otherwise, one day we say that's a low, another day we say something else is, and we're not being consistent in what we're doing. So, first thing we do is, as prices are going up, we just say that the prior day's low, in this case because we're looking at a daily chart, is our first reference point of support. If you were looking at a 5-minute chart, it would be the prior bar's low. It's the same thing. Everything that we teach is universal and applicable to all time frames and all tradable instruments. That's how you know it's the truth. It's not based on bonds or just the S&P 500 or gold or Apple Computer, some type of approach just related to that. You can apply it to anything. So we know that the markets moved higher yesterday. The S&P 500 took out these highs, and so now we've got a wider range bar pushing to the upside, which suggests it could go higher. Many times after a wide range bar, you'll get an inside bar, and then from there, what you don't want to see is it break below the low of the inside bar. If it does, that's a short-term sell signal. Then you'd be breaking a prior day's low. If it continues to move up, we just continue to monitor the prior day's low. So as of today, that low is our first reference point. Now, what is a swing low? Well, we define that as a bar that has a minimum of 3 higher lows to the left and the right. And it does not matter how they form, meaning they could be consecutive higher high, higher low bars, or they could be two sideways and then another one with a higher high, higher low. And what we do is we just connect those swing highs and swing lows as they form. And once the prices make a new high, we just mark off the prior low. Now that's our second reference point of support, and a violation of that will violate the trend, and it'll violate uptrend lines if you draw them every single time. In essence, that one rule makes trend lines useless. You don't need them anymore. Okay? So now, what do we have just related to these indices that we're looking at? Where is a prior swing low with 3 lower highs? It's way down here. So what's happening now is that the markets are beginning to accelerate to the upside. They stalled here for a day. And what you want to be careful of is if they just continue to shoot straight up from here and form a void below of any support. The further prices push higher to the downside, to the upside, the greater the probability of a deeper correction or longer sideways consolidation to consolidate those gains, either sideways or down. So we'll see. And the Qs are doing the same thing. And as you can see, the Russell here is kind of plodding along like an old lady, so to speak, just kind of staying up with the crowd, and it's moving up, and we've got some support down here, and looks like maybe it just barely took out that high. I'd have to get a little measuring tool out here just to see what the highs and lows are, but it looks like it can continue to push up here. So that's our systematic way of following the trend. So regardless of what anyone's opinion is, what I just explained to you gives you the ability to objectively follow the trend. Now, while you're doing that, if the trend should break in the daily time frame, you have the ability to switch to the weekly time frame and now apply the same thing. And what master traders do is they use multiple time frames to do trend analysis, and when shorter terms are in a downtrend and meet a higher time frame in an uptrend, it presents opportunities to make money. I hope that helps. We'll talk tomorrow. And subscribe to that channel and get an update as to whether the stock market is going to crash in 2018. And if so, when will that be? Good trading.